Howdy, Jacob here. Today we're looking at Qualcomm Incorporated. I know when we went over Ericsson previously, I said that was the first company I owned. I don't know if Qualcomm was the second, third, or fourth, but my first group of stocks that I owned was just because I thought 5G was going to be this explosive thing because I read so many articles on it. So Qualcomm was one of the first companies that I invested in as well. So just a little fun story there. Semiconductor industry, 183 billion market cap, slightly higher enterprise value. I mean, they used to do it was like the Fire Dragon or something. They had such a cool name. Semiconductor chip for the Apple phones. Now Apple does their own phones, or it's what is it? The Qual Dragon. I cannot Snapdragon. I think that's what it's called. But they had some chip that went to the Apple phones. Now they don't they don't have the chips in Apple phones anymore. But still a fantastic company. I mean, you're looking at a company that produces chips for so many other businesses commercially. 26.5 billion market cap in 2014 to 36 billion in 2023. Not a lot of growth. And again, semiconductor industry, pretty volatile. We see growth as high as 42% year over year and as negative 7%. Gross margin, very impressive in the upper 50s, actually down from 10 years ago. And operating margins also down from 10 years ago. But that could just be the cyclicality of the business. That is just last year was 36%, higher than the 28.5% in 2014. Earnings per share, not as up as I thought they would be in relation to revenue, but still pretty solid. Dividend over double. Return on invested capital has been very impressive, averaging 20%. So very, very impressive feat there. Balance sheet has about 11.3 billion in cash-like products with 14.4 billion long-term debt, just under a billion short-term debt. In relation to free cash flow, that 14 billion is 2 years of their 5-year free cash flow. We're probably looking at 7-8 million here. Let's say 8 million. And their use of cash, their dividend pays out maybe 40 to 45% of their 5-year average free cash flow. That share repurchases make up about 30%, and that remaining 30% goes into acquisitions, reinvestment, debt repurchases. They haven't issued debt since 2017 for actually it doesn't look like anything. So since 2017, they've actually been repurchasing debt down a bit. So that's making the company, a safer business. And for a company as big as them, I wonder what their growth opportunities are. So for them to be making acquisitions, I do hope that these are making the business more efficient. But it actually doesn't look like it since their margins are down a little bit. But that would be most advantageous. Obviously, reinvesting 20% would be great. But for a business as old as them, paying a dividend, paying out shares, or buying back shares with 75% of their cash flow makes sense to me. Let's start making some assumptions here on the revenue growth side. It's a cyclical business. So again, just take a approximation of what you think it's going to do per year for the next 7 years. And I do think 5% seems pretty reasonable to me. It is a pretty well-known business. And then outside of the cyclicality of the business, I think they're pretty consistent within it. So I'll put a bit of a premium there. 18 P price free cash flow with margins at 22%. Buying back 1% of shares would be about 1.8 billion. With their stock-based compensation is huge now, 2.4 billion. I mean, they have to buy back 0.5% of shares would be about 900 million, which would mean they'd have to pay roughly 3.4 billion in share repurchases just to offset their stock-based compensation. I mean, I think flat. I think they're gonna buy back as many shares as they're issuing, and that 30% growth left is going to go to revenue through acquisition and reinvestment. The dividend hasn't been growing too much. Let's grow that with their revenue growth. So the payout stays flat. And we're saying it looks quite a bit expensive here. needs to fall 53% before you get the return we're looking for here. I mean, it's a well-established business. I don't know how much growth there's going to be. I think that they have the capability. If they have the capability of really putting the steps forward in the AI realm, I mean, just people don't really know how big that industry is going to get, and I could see how expansive it could be, and so I could imagine it being pretty good business from that standpoint. But again, everything is the price you pay for it. So even if the company grows 10% a year over the next 7 years and then drops to 5%, you can calculate that. And I presume even that would look a bit expensive at this price. But hopefully you do enjoy the video and have a great rest of your day. Thank you.